Today, Bank of America manages over $3 trillion in assets. It operates with a highly structured, distinctly Wall Street efficiency, commanding a global network of algorithmic trading, corporate acquisitions, and institutional wealth management. This chart shows a stark contrast. The blue line tracks the bank's massive asset growth over recent decades. Now look at the second line. That's the volume of regulatory fines, unauthorized account violations, and customer service disputes. As the bank expanded its footprint, the machinery required to run it became increasingly bloated and heavily penalized. The man in this photograph is Amadeo Giannini. He was an Italian immigrant who built this global behemoth with exactly the opposite intention. He started his own bank specifically to dismantle the corrupt elite banking practices that ignored working-class citizens in early 1900 San Francisco. Giannini's model was entirely local. He operated out of the North Beach neighborhood, offering uncollateralized loans to immigrants who barely spoke English. He ignored rigid financial metrics. Instead, he handed out cash based purely on a handshake and personal trust. A bank built on local trust operates far differently than an institution managing $3 trillion. Surviving a century of natural disasters, market crashes, and hostile corporate takeovers required a severe evolution. Bank of America had to slowly trade its founder's personal touch for the exact Wall Street mechanics it was built to fight. On April 18, 1906, an earthquake measuring 7.9 on the Richter scale shattered the city's physical and financial infrastructure. Traditional banks, with their grand stone facades, were completely paralyzed, destroyed or trapped behind vault doors they couldn't open as fires raged across the city. Giannini didn't wait for the fires to clear. He loaded his bank's cash, gold, and silver onto horse-drawn wagons, disguised them under crates of fruit, and moved the funds out. Days later, he set up a makeshift desk on the street, immediately issuing handshake loans to anyone needing to rebuild. Because he lent money when traditional banks locked their doors, his localized operation became the most trusted institution in the region. Deposits poured in, catapulting his single branch into a California empire. But building a national network meant entering New York. Giannini acquired multiple banks on Wall Street, challenging the established East Coast monopoly. That rapid expansion caught the attention of Jack Morgan, the most powerful banker in the country, who immediately viewed Giannini as a direct threat. Morgan weaponized his immense influence. He launched a coordinated smear campaign, rallying traders to dump Giannini's bank stocks. When Black Tuesday devastated the broader market in 1929, Morgan used the resulting panic to force Giannini to resign, installing New York loyalists to take over the board of directors. Giannini still held massive shares, and he realized he had one asset Morgan lacked: the trust of the working-class depositors. He bypassed the financial engineering of Wall Street entirely. He launched a grassroots proxy fight, touring the country to personally ask common shareholders to vote with him. The strategy worked. The majority of the shareholders backed Giannini. They fired the Morgan loyalists, cleared out the board, and placed Giannini back in control of his company. In the 1930s, a leader's personal reputation and the loyalty of working-class customers were still enough to outmaneuver the entrenched power of Wall Street. Following World War II, the United States economy entered a period of massive, sustained growth. Consumer demand skyrocketed. The volume of daily transactions meant a handshake-based banking model was impossible to maintain. The bank had to scale up. In 1959, the bank mailed 2 million plastic cards to California families. The Bank America card gave ordinary consumers an instant line of revolving credit without speaking to a loan officer, completely restructuring how Americans spent money. That massive influx of automated transactions drove Bank of America's assets over $12 billion by 1961. But that scale came with severe side effects. The bank grew increasingly bloated, buried under layers of slow-moving bureaucracy. Competitors noticed. In the early 1970s, Citibank poured $50 million into a massive gamble, installing automated teller machines across New York. By aggressively adopting electronic funds transfer, Citibank bypassed human tellers entirely and briefly overtook Bank of America as the largest commercial bank in the country. Personal relationships had been replaced by credit algorithms and electronic networks. Bank of America was now a massive, slow-moving giant. highly vulnerable to the aggressive corporate predators emerging in the 1980s. By the mid-1980s, under CEO Sam Armacost, the bank was bleeding capital. A scandal involving fraudulent mortgage-backed securities cost the bank nearly $100 million, cratering their stock price and exposing weak technological infrastructure. A dying giant inevitably attracts predators. Enter Sandy Weil. He specialized in acquiring underperforming companies, ruthlessly cutting costs, and consolidating their operations to build massive financial empires. Seeing the stock plummet, Weil secured billions from investment banks to launch a hostile takeover of Bank of America. To stop the raid, the board fired Armacost and brought back former CEO A.W. Clausen. Clausen knew that touring the country to ask for shareholder loyalty wouldn't work against a modern corporate raider. He had to deploy Wall Street's most aggressive defense mechanisms. This diagram shows his primary tactic, the poison pill. Clausen flooded the market by issuing a massive wave of new shares to existing stockholders. This instantly diluted the total ownership percentage, forcing the price of acquiring a controlling stake to become mathematically ruinous for Weil. Clausen followed up with a scorched earth strategy. He actively sold off the bank's most profitable and appealing assets, including the recently acquired Charles Schwab brokerage, intentionally making Bank of America less valuable and therefore less attractive to predators. To repel the takeover and survive the decade, Bank of America officially abandoned its populist handshake roots. It fully embraced the cold, highly technical financial engineering of the modern market. That aggressive corporate playbook accelerated into the new millennium. Bank of America absorbed massive institutions, notably acquiring Countrywide Financial. But that specific deal loaded their balance sheets with toxic mortgage assets, right as the collapse of Lehman Brothers sent the global banking sector into a tailspin in 2008. When the 1906 earthquake hit, Giannini survived by relying on local immigrant deposits. In 2008, the scale was entirely different. Survival required a $45 billion government bailout, a forced merger with Merrill Lynch, and a massive $5 billion capital injection from Wall Street insiders like Warren Buffett. To stabilize the resulting chaos, current CEO Brian Moynihan didn't rely on populist charm. He engineered a massive structural recovery. He purged risky assets, cut operational costs, and focused heavily on algorithmic efficiency and the migration of the bank's core infrastructure into mobile and automated systems. Financial systems are forged by the crises they endure. Amadeo Giannini's absolute reliance on personal trust is what built the initial empire. But it was aggressive financial warfare, poison pills, and trillion-dollar government interventions that ultimately kept it alive. Bank of America survived the century by becoming the exact Wall Street giant it was originally created to destroy. Let us know down in the comments which historical corporate war we should dissect next. And as always, thanks for watching.